Tonight we're going to spend like the next 30 minutes or so just talking about an actual case study. This is one of my case studies, investing in multifamily, and how I got an $86,000 tax deduction as a passive investment. And just want to share this with you guys before we kick this off. I've got some slides I'm going to share with you guys, but I did want to thank you. I did want to just share a little bit about me, myself, just my story, because some of you guys may not know me, and just kind of like how did I get into this? And for me, really, I was looking for a way personally just to put my money to work into something outside of a retirement account, because I was taught growing up to just get a good job and save all my money. And that's what I did. I put it all in a 401k, thinking that I was doing all the right things, is saving my money and just, watching that money accumulate and grow. And I remember at one point seeing my 401k down 30% in a single year, and I lost hundreds of thousands of dollars. And I'm like, there's got to be a better way to do this. That kind of really got me looking at real estate, because, we all know that like real estate is a great way to accumulate wealth and just kind of to grow by investing in real estate and real estate properties. I'm going to check this one thing really quick. Just check my mic again. And I was like, well, I don't even know how to get started in real estate. So what do? I did a single family flip, and that was profitable, but there was no scalability. I thought that's going to be really hard to scale that and grow something exponentially. And I looked at a lot of different asset classes, and multifamily really just checked all the boxes for me. It had the scalability I was looking for. It had just growing my money exponentially, something passive I can invest in when I didn't have a lot of time to be hands-on. And also some great tax benefits. That wasn't even a reason I got started, but turns out it's one of my favorite reasons. And all of this really got me thinking too, is that, to be honest, I don't want to work until I'm 70. All this, my parents are in their 70s and they're both still working, and I hate that for them. I don't want them to have to work, and I don't want to work until I'm 70, but that's a reality that a lot of people are facing. And it's sad, because there are other ways. We think we're doing all the right things by saving our money and putting them in retirement accounts or the stock market. And sometimes it's just not enough. We think we're doing the right thing. So I like sharing this now with other people, because I didn't even know that multifamily investing was an option. And when I talk to people, I realize that there's a lot of people in the same boat as me that are looking for other ways to put their money to work. I mean, I want my money to work as hard as I did for it. I want it to work just as hard for me, right? And we work really hard for our money, and it's important that we put that to work in smart places. So that's really just it. So this is just an education. I like sharing these education series just to kind of share my knowledge. I've been in this space since 2019, and I've learned a lot along the way. Although I will, let me start with this disclaimer that I am not a CPA. I am not an attorney. But I am an investor, and I'm just sharing my personal experiences, which is why we're going to look at today is a case study of my of personal experience of mine. So I think with that, let me go ahead and share my screen here. And then let me see if I can just get that in did that work to get in a better thing? So that should hopefully maximize that for you guys. Again, though, if anything doesn't look right or you guys can't hear me for any reason, if anything happens, if you guys fall off, just shoot me a chat or in the Q&A. So here's the case study that we're going to look at: an $86,000 tax deduction. It's fun stuff. And again, I mentioned already a little bit that I started in 2019. I started investing passively, so I didn't really have a lot of time to be hands-on in these projects, but I wanted to put my money to work immediately. And then as I started learning more about the industry, and I ended up joining a team of general partners that have been doing this since 2012, ended up joining their team, and now I'm a general partner. So collectively now all of my personal investments as a general partner and limited partner, I'm in about 700 doors. So that means like 700 different units. And our portfolio right now is about $60 million. So it's pretty cool. It's a really great way to grow. Like I said, that's a big difference between the single family flip I did was $160,000. You can take that $160,000 and put it into, instead of doing a single family flip, you can put it into an apartment building, the apartment complex, and grow that money exponentially. So, but it takes a team. We're buying multi-million dollar properties, 10, 20, $30 million properties. And that takes a whole team. And so this group, these little boxes down here, are some of our partners. We've got a team of attorneys and CPAs, advisors, lenders, property management companies that we work with. And kind of what we do, I touched on this a little bit already, so I'll keep this brief, but we're essentially buying multi-million dollar apartment complexes, and we're improving the condition of the property. So we might be doing renovations, we might be adding amenities that the property didn't already have. Or maybe we're improving the operating efficiency, kind of reducing expenses wherever we can. And all of these things increase the value of the property, which we then can sell to another group of investors. And the cool thing about this, though, is we all, as investors, we all co-own this property, whether you're a general partner where you're actively involved in the deal, or you're a passive investor, you're a limited partner that just has your money to work, but you're not really doing any of the work, just your money's working for you. Either way, we all collectively own these properties, which is really cool. For any of my, I know a couple people on here tonight are in the Dallas area. The properties that we buy, we're typically buying in really, really good areas. We love DFW, we love Nashville, but we're also buying in little neighborhoods that we know are really good, strong growth neighborhoods. We have a property that's right by the Galleria in Dallas, one that's also in North Dallas, that Beltline in Preston, A-rated schools, things like that we look for that are really good areas to invest. I also love this, though, that while we do this, we also improve the residents' home. We've all lived in an apartment at one point or another, and this is where residents live. This is their home. And I like that it also improves their communities at the same time. Again, I'm just going to kind of touch on this really quickly so we can get into our hot topic of taxes. But just a couple of things if you're not familiar with multifamily already, just, why multifamily? Why are we even looking at this asset class? One of the things is steady cash flow. You, as an investor, you get dividends that are paid quarterly. So the property is cash flowing and you get to receive dividends. Strong demand. There's always going to be a need for a housing. Right now, especially any of my Texas sites that are living here, my Texans, there's an unprecedented migration to the Sunbelt states, as you guys are well aware of that, and that is pushing rents. There's a housing shortage right now as well. Experts are saying that it's going to be a decade before that resolves. So for the next decade, we're looking at there's not very many single family homes. That's going to push people into renting. And then, of course, right now with interest rates, that's a whole other issue, is that unfortunately with interest rates being higher, that's going to push people, unfortunately, out of being able to qualify to purchase a home. And that is going to push more people to rent. So the demand is always there. No matter the cycle, there is always a demand for apartments. Stability, though, I love this one. This was the main reason I got into it. The S&P was down 18% last year. 401ks lost 23%. That was me. But apartments are recession resistant, which is really nice. Even multifamily was the strongest performing asset class during the COVID pandemic, which was surprising to hear, but it's because people need a place to live. You're always going to need a place to live. I mean, that's just a fact. So Forbes even says that multifamily has substantially lower volatility than public markets, i.e. the stock market. And then tax benefits. I'm going to skip this one since we're going to spend the majority of our time. We're going to do a deep dive on that one tonight. And so we'll skip down to appreciation and inflation hedge. Real estate continues to appreciate over time, right? So there can be fluctuations in the market. There always will be. Of course, there's going to be. But over time, if you look at history, real estate really just goes one direction. It does increase over time. And then also the inflation hedge side of it too, with inflation going on and just in general, the value of the dollar is always going to decrease. So if your money is idle, you do have idle money that's not doing anything, if it's sitting on the sidelines, it is losing money. So it is nice to put your money into something that is cash flowing and that's going to kind of continue to grow that for you. And then we touched on this as well, economies of scale. It makes more sense. We can do more together, right? If we pool our money, we can buy a larger asset, and that's going to help all of us collectively grow farther, go farther faster. So let's get into this. Again, I made the disclaimer for anyone that has recently hopped on. I made the disclaimer. I am not a CPA, but I've learned a lot. And so Robert Kiyosaki, you guys know, who wrote Rich Dad, Poor Dad and the Cash Flow Quadrant. Love him. Look up some of his books. He's fantastic. He says taxes are your largest single expense. It's true. So the whole thing here, like when we're looking at investors are looking not only really just to at like when they look at an investment, we're not looking just at the projected income that from an investment, but we're also looking at the depreciation benefit. So that's really the main focus of what we're looking at today. But we hear taxes and we're like, oh my gosh, there's a lot of misnomers about taxes. We think like the IRS, like we want to hide. We think they're out to get us, right? It's, tax laws were created to raise taxes, and there's no legal way to avoid paying taxes. We just have to do it. That's not true. Actually, these are true, though. 95% of the tax code is intended to stimulate the economy. The government is our partner. And the tax code is actually a guide to reduce taxes and generate more cash flow. The government actually wants you to invest in different assets, and it gives you incentives to do so. The truth is, really, the tax code can actually help you save thousands of dollars legally. And that's exactly what we're looking at today. So first, let's kind of look at the types of income, because this is important to our conversation as well. So we talked about how investors looking at different, when they're looking at projections on a potential investment, you're looking at, well, what are the projections? What's the income potential? So let's kind of look at that for a second, because this is important. So we've got the main three buckets of income are active income, portfolio income, passive income. So your active income, ordinary income, this is like your W-2 income, right, from your job. Portfolio income is going to be capital gains. And then passive income is where you are not actively involved, but you're getting passive income from an investment. So we're mainly talking about the active and passive income tonight, and losses. So when we think about losses, they have to stay within each bucket. So a loss, like a passive loss, for example, can only offset passive income. The only exception is that ordinary losses can offset any three of those buckets, starting at the top. So kind of starts at the top. So an ordinary loss can offset ordinary income, active income. And then if you have overflow from that, it kind of trickles down. So that's the only exception. So we're kind of always seeking the ordinary losses, because the whole goal is, here's my income, right? This is my total income of whatever it is, whatever form of income I'm looking at. And then I pay taxes on that income. So if I can reduce the taxes if I can reduce that number of the income that I'm paying taxes on, I get to keep more of that. More of that goes into my pocket instead of going into the government's pocket legally. So that's kind of what we've been looking at tonight. And then again, think about, like, when we're talking about the losses, we're going to be looking at like depreciation, paper losses. It doesn't mean that the asset lost money. It just means that we are depreciating things on the property that are going to depreciate over time anyway. So that's kind of what we're looking at as a paper loss here. So I'm sharing actually this is a real K1 statement, Schedule K1, and you can see I've kind of blocked out some of the things like my social that I don't want to share tonight with you guys, but that is my real K1. You can see my name on there, Dawn Keller. You can see that I have an $86,000 loss. 86,135 is my loss from this K1 in 2021. So this is a paper loss that I received on a passive investment. So how did I get this $86,000 loss? That's what we're going to kind of look at tonight. And in order to do that, one of the first things we're going to talk about is a cost segregation study. So if you are looking at investing in a multifamily asset, if you're looking at investing in a property, you're evaluating it, you should definitely ask the general partner team if they are planning on doing a cost segregation study. The answer should always be yes. There is no reason not to. It does cost money, $5,000, maybe $10,000, but it is well worth it. The savings that you're going to get by doing a cost segregation study is well worth it. So essentially what we're doing in a cost segregation study, so residential real estate has a lifespan of 27 and a half years. You can't depreciate the land. The land's always going to have value. Even if the building burned to the ground, the land is still going to have value, right? So we can't do that. But so let's take the land out. Let's look at this first pie chart at the top. We're taking out, take out 20% is the land and 80% is the building. So over 27 and a half years, that building is going to depreciate. A cost segregation study, though, is actually going to there's certain things that depreciate at different rates, like 5 years, 7 years, 15 years, and then the 27 and a half. So a cost segregation study will actually divide all of those things into different buckets so we can depreciate them at faster rates. So let's say, so you've got right here, now we still have our land as 20%, but we have now our building is only 50%, not 80%, because the other 30% is going to be land improvements, 20%, and then personal property at 10%. So land improvements might be improvements might be something like, walkways or parking structures, things that you've added to the property to improve it. And then the personal property is going to be things like, I have a 100-unit apartment complex and I'm going to have 100 dishwashers in there, and I'm going to have 100 ovens and 100 microwaves. So any of those things, light fixtures, all of those things are the personal property that can depreciate at a much faster rate. So now we're going to segment them all into different buckets so we can depreciate them faster. I'm going to check in on you guys really quick. All good. We'll keep it going. Okay, so this is an example. I'm going to break this down for you guys. I tried to make it really simple. So on the left here, we're looking at a chart that is straight line depreciation. That was that first pie chart. We took out the land, and then we've got 80% is the building. So let's say we have this example. Let's say it's a $10 million property. Okay, so the building is going to be worth $8 million. We have to depreciate that over 27 and a half years. So that's going to be $290,000 a year that we can depreciate, right? Now, as an investor, I don't own this whole $10 million property. Let's say I did a $100,000 investment. Okay, so my share is 1% of the property. That means personally, as a personal investor, I get a $2,900 deduction every year that I'm in this investment. Not bad. But if we did a cost segregation study, we're going to take it a step further. We have our land, 20%. Now our building is 50% because we've broken down our improvements in personal property that accelerate depreciation at 15 years and 5 years. And now all of a sudden we can depreciate $515,000 a year instead of $290,000. As a personal investor, that means in my pocket, I get to deduct $5,100, almost double of what I was able to do without the cost segregation study. So right there, I'm loving it, right? This is great. So always, 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 there should be no reason to not do a cost seg study. Always do it. But it gets better. So there is a lovely tax law called bonus depreciation that it allows us to take all of the depreciation in year one. This is the year that we buy the property, that we first purchase the property. So I crossed it out, but you can kind of still see over here. This is our example from the last slide. Let's say we have that $5,100 tax deduction every year. Let's say we hold the property for 5 years. So over the life of that 5-year hold, we would be able to deduct we'd have a $25,000, almost $26,000 total depreciation loss. That's not bad. Great. But with bonus depreciation, we can take all of these things over here, all this depreciation, we can take it all in year one. And we want to take it all in year one. Not only is it because I'm only holding this property for 5 years, well, I'm not going to wait 15 years or 27 and a half years, right? So if I can take it all in year one, yes, absolutely sign me up. I want it all day one, year one. So if we did, and then 2023, it is, unfortunately, this is a tax law that is being phased out. I know it's very sad. It's a tax law that Trump put into place in, I believe, in 2017, and it started out at 100%. 2023 is 80%. Next year in 2024 will be 60%. It's going to go down 20% every year until it's phased out. So unless something else changes and somebody else wants to reinstate it, would be awesome. But I digress. So we've got our year one, same investment. Let's say we did a $100,000 investment on this, but let's say since we get a max of 80%, now we have an $80,000 deduction, paper loss again, a depreciation loss. So instead of over here 25,000, now we've got an $80,000 deduction right off the bat. Love that. Plus, we talked about earlier that $1 today is worth more than $1 in the future. So it's definitely beneficial to take it now rather than later. So kind of let's just continue on that example. Without bonus depreciation, let's say now we sell the property. Let's say 5 years down the road, we sell the property and we made $100,000 profit. Great. Let's say we pay 20% on that, 20% tax on that investment. Because it's a passive investment, it's not going to be taxed like at your regular income rate. So let's just say, we'll use 20%. So you're going to be paying $20,000 in taxes on that profit. So you get to keep $80,000. But with bonus depreciation, you get to have your $100,000 profit. You get to deduct that $80,000, and then that $80,000 deduction, and then you pay taxes on what's left. So you're only paying $4,000 in taxes. So you get to keep $96,000, much better than the $80,000. So it's a $16,000 savings that is going into your pocket instead of the government's pocket, right there for basically doing absolutely nothing. And then one more thing, just to make this even better. There is a status called a real estate professional. And to qualify as a real estate professional, there are 2 qualifications. You have to spend at least 750 hours a year in material participation on real estate related activities. And you have to do that more than any other income producing activity. So you wouldn't necessarily qualify if you have a W-2 job, but you're also working on real estate, investing in real estate, because you're probably spending more time in your W-2 job than you are in your real estate related activities. However, let's say that you're married, and let's say one of you has a W-2 job. Let's say spouse A is a doctor that is married to, now that I see this, it looks more like a hospital sign, but I meant that to be like a married, like happy heart with a plus sign in it. So spouse A plus spouse B. Let's say that doctor, spouse A, is married to spouse B that is a real estate professional. And now all of a sudden, all of your income gets transferred to active income, which means all of your losses can now be active losses. It's amazing. So let's look at that same scenario again with this same Schedule K1 that we looked at with my $86,000 loss in a real scenario, where if I were a regular taxpayer and let's say my spouse and I, my combined household income is $500,000. Let's say we're going to be in the 37% tax bracket. We're going to pay $185,000 in taxes. So the net, we get to keep $315,000. But with a real estate professional status, that same $500,000 household income, we can now take this 1K1 over here, this $86,000 loss deduction, and we can apply it to all of our household income. It doesn't matter who earned that income. We can apply it, even though if this may be a passive loss, it doesn't matter because now we qualify as active. And now we're going to reduce our taxable income to $413,000. And we pay that same 30%. Now we're only paying $153,000 in taxes. And that's an extra $31,000, almost $32,000 in your pocket. So amazing when you can do that. Imagine if you did that a couple of those a year. And again, this is not only showing you we're not even looking at the income producing side of an investment. We're just looking at how much you can save, how much you can keep, because it's not always about how much you can make. It's how much that you can keep. We work so hard, for that money, and the less of it that we can give away, the more that we can keep in our pocket, the better, right? So that's really what this is about. This is putting your money to work, my friends. This is how it's done. So love this example because it just gets multiplied more and more. And that is really it for you guys tonight. I know it was kind of short and sweet, but I wanted to kind of get through the highlights. I mean, and I don't want to talk with you guys about taxes forever, but I do have a referral program. If you guys like what you heard tonight and you want more, or you think that you might know somebody that is interested in learning more, feel free to send it my way. If that person eventually becomes an investor, I will donate $150 to the charity of your choice. I believe in giving back. It's one of the ways that I think that we can spread wealth and make this a better world. That's just me personally. And then also I'll leave you guys with this too, is a way to get in touch with me. If you want to scan this QR code, that is going to get you to a form where you can fill out if you want to do like a one-on-one call. If you have questions for me, we can kind of get together like one-on-one. But I would definitely encourage you guys to do this. Just, take 10 or 15 minutes out of your day to schedule a call, and we can talk more about your specific situation. If you have more questions on taxes or just investing in general, multi investing, anything that I can help you with, I'm happy to help. So many people have helped me along the way, and I really like sharing these things and helping other people. So you can also visit my website, crownmultifamily.com. You can schedule a call there as well. And there's also just some things on there that you might find helpful to you guys. So